Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. The major U.S. indices are back at all-time highs. Investors have shrugged off concerns about tariffs. The S&P 500 is up nearly 30% from the low on April 8th. While media headlines focus on political intrigue in Washington, the markets are reacting to earnings. Most companies report their quarterly earnings by the end of the month after the close of the quarter. By the end of July, most of the June quarter results are in. Wall Street analysts were forecasting $62 per share for the combined companies in the S&P 500. It now looks like the total will be closer to $64.59. While $2.60 doesn't sound like much, the better than anticipated results have a waterfall effect, raising expectations for next quarter, this year, and next year. With better earnings, stocks look cheaper, driving prices higher. Corporate profits in 2026 are expected to hit $300 per share for the combined S&P 500. That represents more than 16% year-over-year growth, which that'd be an acceleration from the very good 11% growth we saw in 2025. We worry a lot more about broad economic growth than anything else. Inflation matters because it can slow growth. Taxes, regulation, and tariffs also can slow growth. Lately, the financial headlines have focused on interest rates. Lower interest rates can increase growth, which is why the White House is putting pressure on the Federal Reserve to cut rates. But cutting rates is not as simple as it sounds. There are downstream impacts that could be very counterproductive. Rate cuts are generally necessary when growth is slowing, which is why rates were so abnormally low during the pandemic. The government sought to keep the economy going while workers were stuck at home. Interest rate cuts reacting to lower growth would certainly not be positive for stock prices. While the market may cheer a rate cut in the moment, the lift will not last long if the reason for lower rates is a weakening outlook and reduced future earnings. Economic growth impacts interest rates more than interest rates affect economic growth. So what about tariffs? Tariffs and trade really affect you if you're trying to run a business that imports products, but the impact on the broader economy is less direct. Foreign goods affected by tariffs make up less than 10% of the total consumer price index. The U.S. economy is more than 70% services. The rest is goods. So analysts put the annual economic drag from tariffs at about 0.5% of gross domestic product. I don't want to say that they don't matter. They do, but only marginally. They impact certain businesses, certain industries, and certain countries more than others. More important than interest rates or inflation or tariffs is employment and household income. If people have jobs and are making money, the economy will hold up. We need employment to remain strong. People who want to work need jobs and income. Unemployment data has been weakening, but unemployment remains low at 4.2%. Household income per capita is very near its all-time high, which is just under $66,000. These are the data points that matter most. There are periods when investors get too optimistic for the economic outlook. Financial crises do suddenly materialize that in hindsight we think we should have seen coming. And then in periods of economic decline, pessimism takes over and investors sell at the bottom when they should be buying. The pendulum often swings too far. We try to focus on companies that are growing, companies that have products and services that will continue to enjoy demand for the foreseeable future. While U.S. stocks are up nearly 10%, this year has been challenging. Consumer discretionary is down nearly 2% due to tariff impacts on imported goods. Energy stocks are also negative, due largely to declining oil prices. Healthcare has been terribly difficult for investors and is the worst performing sector this year, down more than 5%. The sector can't catch a break with rising costs, threats of restrictions on drug pricing, Medicare drug reimbursement rates, and tariffs on pharmaceuticals. For equities this year, the place to be has been everywhere except the U.S. Stocks of foreign countries are outperforming for the first time in years. The global stock index, excluding U.S. companies, is up 22% year to date. The combination of a weakening dollar, trade wars, and relative lower valuations are all working in tandem to push international stocks higher. Despite generally slower economic growth outside the U.S., there are many compelling companies, perfect for diversifying equity portfolios beyond large cap stocks. So that's all I have for today. For more detail on our analysis, you can download our quarterly update from our website at www.gkvcapital.com. Thank you very much for watching.